Cell 1. In this cell, we're diving into practical examples of probabilistic modeling using Python. This approach is crucial because it allows us to handle uncertainty effectively by utilizing probability distributions. As we proceed, we'll explore three common patterns in this realm, beginning with simpler concepts and gradually moving toward more complex, real-world applications. The core idea here is to model uncertainty, which is fundamental in various fields, be it finance, healthcare, or machine learning. By employing probability distributions, we can calculate essential metrics like posterior probabilities and credible intervals, giving us a clearer understanding of risk and variation within our datasets. Throughout this process, we'll apply these ideas in a runnable Python format, making it accessible and practical. An important aspect to keep in mind as we work through these examples is the distinction between theoretical concepts and their practical implementations. In more realistic scenarios, we often have to make assumptions about our data, and there's always the risk of oversimplifying complex situations. As we explore these patterns, you'll notice how even slight variations in assumptions can lead to different outcomes, influencing how we interpret results. The goal is not to achieve absolute comprehensiveness, as that would be virtually impossible given the complexity of the field. Instead, we're focusing on delivering a well-rounded understanding that will allow for further exploration of probabilistic modeling techniques. This holistic approach will serve as a solid foundation for any future analyses you undertake. As we wrap up this cell, get ready to see how these fundamental principles will be applied in more specific contexts in the next section. This transition will help solidify your grasp of the ideas we've covered, allowing you to tackle more nuanced challenges ahead. Cell 2. In this cell, we delve into Bayesian analysis to estimate a probability distribution for a conversion rate based on observed data. This approach is particularly useful when you want to incorporate prior beliefs alongside the actual information you gather through trials, allowing you to refine your understanding of metrics like approval rates or fraud detection. We start by defining our prior belief about the conversion rate, represented by a beta distribution with specific parameters. Here we set the alpha parameter to 2 and beta to 18, which results in a mean conversion rate of just 10%. This choice reflects a belief that the conversion rate is low, but it's essential that these prior values make sense in the context of our specific application. Next, we introduce the observed data. We've conducted 500 trials and recorded 80 successes, which provides us with concrete evidence to update our beliefs. The core of Bayesian inference comes into play when we compute the posterior distribution. Using our prior parameters and the observed data, we adjust the alpha and beta values to create a new beta distribution that encapsulates both our prior belief and the data we've gathered. The posterior mean gives us a single estimate of the conversion rate after taking into account both our prior and observed results. But there's more to discover. We also create a 95% credible interval through simulation, which allows us to capture a range of plausible values for the conversion rate. This interval is particularly important as it provides insight into the uncertainty surrounding our estimate. Finally, we take it a step further by calculating the probability that the conversion rate exceeds 15%. This particular insight is valuable for making decisions, such as whether to invest more resources into a campaign or adjust strategies based on the likelihood of achieving a certain threshold. As we move forward, the next cell will likely build upon these concepts, perhaps by exploring how to visualize these distributions or by introducing additional data complexities. This will enable us to better understand the implications of our findings in a real-world context. Cell 3. In this cell, we're diving into the concept of credit default probability while incorporating uncertainty through a Bayesian approach. Specifically, we're looking at how to calculate the posterior default rate based on observed data, which is crucial for making informed underwriting and risk management decisions in finance. To begin, we establish a prior belief about the expected default rate, which is set at around 3%. This is represented by two alpha and beta parameters, 3 and 97 respectively. These parameters hint at our initial assumption that defaults are relatively infrequent. Next, we consider the observable data. Here, we have a segment of 1,200 loans with 55 recorded defaults. This information is pivotal because it updates our beliefs about the likelihood of defaults in this group. The key part of this workflow involves updating our prior parameters, turning them into a posterior distribution. We accomplish this by adding the observed defaults to the alpha parameter and adjusting the beta parameter with the number of loans that did not default. The updated values capture our revised belief about the default probability after considering the new evidence. After setting up the parameters, we use a random number generator to draw 200,000 samples from the beta distribution defined by our updated alpha and beta values. This generates a range of possible default probabilities, allowing us to visualize the uncertainty surrounding the estimate. The next steps involve some interesting calculations. First, we compute the mean of these posterior samples to find our central estimate, which gives us an average default probability based on the evidence we have. We also calculate a 95% credible interval, which provides a range where we can expect the true default probability to lie. This interval is particularly informative as it indicates the uncertainty around our estimate. Finally, we assess the likelihood of the default probability exceeding 6%. This is crucial for risk assessment, as it informs us not just of a point estimate, but of the distribution of probabilities, helping stakeholders make informed decisions based on varying levels of risk. Looking ahead, the next cell will likely build upon these insights, possibly introducing additional data or further refining our understanding of default probabilities in relation to other factors. This continuity is vital for creating a comprehensive risk assessment model. Cell 4. In this cell, we're diving into a Monte Carlo simulation to model loss events through a probabilistic approach. This method is crucial for understanding risk in various domains, especially finance and insurance, as it helps us estimate the frequency and severity of potential losses. The process begins by simulating how often these loss events occur, modeled by a Poisson distribution. We've set an expected event rate of 1.2 per year, generating data across 200,000 years. Each of these years will yield insights into potential losses, shaping our understanding of risk dynamics. The next step focuses on the severity of these losses, which we model using a Lognormal distribution. Here, we've defined parameters for the Lognormal model, specifically a mean of 10 and a standard deviation of 0.8, which can be fine-tuned based on historical data or specific risk scenarios. For each simulated year, we check if there are any events. If losses do occur, we generate the loss amounts based on our Lognormal distribution and sum them up for that year. This results in an array representing total annual losses over the entire simulation period. Once we have our annual losses, we compute a few essential risk metrics: the average annual loss, the value at risk at the 99% confidence level, and the tail value at risk, which provides insight into the average loss when we exceed that threshold. We're also calculating the probability of incurring any loss in a given year. Each of these metrics helps us understand both the expected and extreme risk scenarios that may arise. As we proceed to the next cell, we'll likely explore how to visually represent these risk metrics, enhancing our ability to communicate insights effectively. Through visualization, we can more easily identify patterns and trends in the simulated loss data, which is critical for making informed decisions. Cell 5. In this cell, we delve into the concept of probabilistic modeling and its practical implications. Understanding probabilistic modeling is crucial because it allows us to incorporate uncertainty into our analyses and decision-making processes. Essentially, we begin by selecting a distribution that captures the uncertainty inherent in our data or predictions. This choice is pivotal, as it shapes how we interpret various scenarios and outcomes. Once we have our distribution established, we can start answering significant questions that can inform our decisions. For instance, we might explore the probability of a certain event exceeding a defined threshold. This can be particularly useful in risk assessment, where understanding the likelihood of extreme outcomes helps to gauge potential risks. We also work with credible intervals, such as the 95% credible interval, which provides a range where we expect our estimates to fall with a high level of confidence. Furthermore, another important aspect is identifying the decision that minimizes expected loss, especially in cost-sensitive contexts. This involves weighing the potential outcomes against their probabilities to make informed choices that mitigate risk. Additionally, we consider how risk might evolve under stress scenarios, which can be vital for strategic planning and ensuring robustness. As we move forward to the next cell, we will likely explore specific examples or algorithms that implement these probabilistic principles, applying them in real-world contexts to see their utility in action. Getting comfortable with the logic behind these concepts will set a solid foundation as we dive deeper into the practical applications of probabilistic modeling techniques. Cell 6. In this cell, we're diving into a crucial aspect of fraud detection, specifically through analyzing expected losses against the costs of reviewing transactions. The goal here is to decide whether a transaction should be flagged for manual review, based on its expected fraud loss in relation to the cost incurred for that review. This decision-making process plays a pivotal role in managing resources effectively while minimizing potential losses. We start by generating a simulated dataset of transactions. Each transaction has an associated amount, drawn from a gamma distribution, and a probability of being fraudulent, generated through a beta distribution that tends to yield lower probabilities. This setup reflects the reality that most transactions are legitimate, with only a few likely to be fraudulent. With 2,000 transactions in hand, we need to assess the financial implications of potential fraud. Next, we compute the expected fraud loss for each transaction. This is done by considering both the expected loss due to fraud, which combines the percentage of the amount we'd lose if fraud occurs, alongside any additional chargeback fees, and the probability of a transaction being fraudulent. The output is stored in a new column, which quantifies our risk for each transaction. After calculating these expected losses, we flag transactions where the anticipated loss exceeds the cost of reviewing them. This binary flagging helps streamline operations by filtering out less risky transactions while highlighting those that warrant further scrutiny. Moving on to the summary statistics, we gather insights into our portfolio of transactions. We calculate the rate at which transactions are flagged, the total expected loss if no reviews are performed, and the potential costs associated with the flagged transactions. Finally, we look at the expected losses after implementing our policy, giving us a clear picture of both risks and costs involved. As we wrap up this cell, it's important to keep in mind the assumptions made in our model, such as the fixed nature of the review cost and fraud loss rate. In the next cell, we'll likely explore how these variables can be fine-tuned, perhaps integrating real-world data to enhance our model further and assess its practical implications. Cell 7. In this cell, we delve into credit underwriting by updating our understanding of the default probability, or PD, for a specific loan segment based on observed defaults. This process is pivotal because it allows us to make data-informed decisions on whether to approve loans, with the aim of ensuring expected profits meet our risk appetite. We begin with a prior belief about the default probability in this loan segment, represented by two parameters, alpha and beta. Here we set alpha to 4 and beta to 96, suggesting an initial expectation of a default rate around 4%. Then we incorporate real-world data. From a total of 800 loans, we've observed 38 defaults. This observed data is crucial as it refines our prior belief into a posterior distribution. The updated parameters alpha post and beta post reflect this new information, allowing us to get a more accurate estimate of the default rate. Subsequently, we leverage a random number generator to sample from this updated beta distribution, creating a large set of potential default probabilities. This sampling with 200,000 iterations provides a robust view of the uncertainty surrounding our estimated default rate. With these sampled probabilities, we can analyze the financial outcome per loan, factoring in the expected profit if the loan isn't defaulted and the potential loss should a default occur. In this analysis, we consider the economics on a per-loan basis. The variables include expected interest profit, which is calculated as $320, along with a loss given default of 55% and an exposure at default of $5,000. The expected profit per loan is therefore a function of both the sampled default probabilities and the defined economic parameters. The outputs of this cell provide critical insights. We compute the mean of the posterior default rate and derive the probability that this rate exceeds 6%. Furthermore, we calculate the expected profit per loan based on our updated estimates and evaluate the likelihood of experiencing a loss on average. These insights help inform our lending decisions, ensuring we are aligning our risk and profit expectations. Looking ahead, the next cell is likely to build upon this analysis, perhaps focusing on how these probabilities and expected profits can inform decision-making processes in credit underwriting, or further refine our risk assessment strategies. Cell 8. In this cell, we're focused on exploring the relationship between price and demand through a probabilistic model, ultimately leading us to determine an optimal price that maximizes expected profit. This approach is significant because it incorporates uncertainty into demand forecasts, allowing for more informed decision-making in pricing strategies. The code begins by defining a basic demand model with three key parameters: a baseline demand scale, the price elasticity that gauges how sensitive demand is to changes in price, and a measure of demand noise to reflect real-world variability. We also define the unit cost of the product and a range of potential prices to analyze. A pivotal function is established, designed to simulate profit based on a given price over multiple trials. This function generates random noise to create variability in demand, reflecting how actual consumer behavior may fluctuate. By calculating a mean profit, along with the 10th and 90th percentiles, the function helps us understand not just the expected profit, but also the range of outcomes we might expect, which can be crucial for managing risk. As we loop through the price range defined earlier, we gather results for each price point. Each iteration captures the expected profit along with its variability metrics, creating a comprehensive view of how different prices might perform in terms of profit. Once we compile these results into a data frame, we identify the price that leads to the highest expected profit, which we'll highlight as the best option. This analysis opens up intriguing discussions about pricing strategies in unpredictable markets and sets the stage for deeper inquiries in the next cell, where we'll likely refine our understanding of how changing these parameters can further impact our demand forecasts and pricing decisions. Cell 9. In this cell, we're diving into a frequency-severity model that plays a crucial role in assessing claims in insurance. By employing mathematical distributions, specifically the Poisson distribution for claim frequency and a Lognormal distribution for claim size, we can estimate key metrics like expected loss, value at risk, and tail value at risk. Understanding these metrics is imperative for setting appropriate premiums and reserves, ensuring financial stability. We begin by initializing a random number generator and defining the number of periods for our simulation. The assumption here is that we expect approximately 0.35 claims per policy per year, which sets the parameter for our Poisson distribution. As we generate the number of claims using this distribution, we then consider the severity of those claims. For severity, we utilize a log-normal distribution and set parameters to mimic realistic claim sizes, incorporating both a deductible and a limit to reflect common insurance practices. The total amount paid out for claims is calculated by iterating through the generated claim counts. If there are no claims in a given period, we simply skip that iteration. For those periods with claims, we determine the severity of each claim using the log-normal distribution, applying the deductible to ensure we only account for claims above that threshold. The results are clipped to honor the specified limit, preventing any inflated expectations on large payouts. Once all calculations are completed, we derive several key metrics: the average amount lost, which serves as our expected loss, and crucially, the 99th percentile value, helping us gauge extreme loss scenarios. Additionally, we calculate the tail value at risk, providing insights into the average of the worst losses beyond this percentile. Lastly, we assess the probability of having at least one claim in the observed periods, giving us a measure of risk exposure. Looking ahead, the next cell will likely expand on these derived metrics, perhaps offering insights into the implications for pricing strategies or deeper explorations into risk management frameworks. Understanding the interplay between these metrics will equip us to make more informed decisions in the insurance landscape. Cell 10. In this cell, we're delving into a Bayesian model to estimate the churn rate, which helps us understand customer retention more effectively. This is crucial because it allows businesses to make data-informed decisions, particularly in assessing whether a retention strategy is worthwhile given its costs. The process begins by setting up a prior belief about the churn rate, which suggests that around 8% of users have been lost historically. We then account for new data by looking at a recent month where 5,000 users were analyzed, and out of these, 520 customers churned. This observed data allows us to refine our estimates, updating our prior beliefs about churn using the beta distribution, a common choice for modeling probabilities. After updating our beliefs, we generate a large sample from this posterior distribution to get a more robust understanding of potential churn rates. This sample will serve as a basis for evaluating our retention strategy. Next, we consider the economic implications of sending out retention offers. Each offer costs $6, but if successful, it could save the user from churning for an average of 3 months, resulting in a monthly profit margin of $12. To evaluate whether our retention strategy makes financial sense, we calculate the expected profit per user targeted. This profit factors in the probability of the offer preventing churn, set at 18%, along with the expected financial benefit of retaining customers. Finally, we examine these expected profits by computing the mean, checking confidence intervals, and determining the likelihood that our strategy will be profitable on average. The outputs provide insights into the potential effectiveness of our approach, allowing businesses to decide wisely whether to proceed with these retention efforts. Looking ahead, the subsequent cell is poised to build upon these calculations, potentially diving deeper into simulations or examining how varying the offer's parameters could influence overall outcomes. By continuing to refine our understanding of churn and retention dynamics, we can further optimize customer retention strategies. Cell 11. In this cell, we're implementing a Monte Carlo simulation to analyze the potential future prices of Apple stock over the next 60 days, using historical return data. This approach is crucial as it allows us to model uncertainty and variability in stock prices, enhancing our decision-making process in investing. First, we pull historical closing prices for Apple using the Y-Finance library, ensuring the data is well-structured, regardless of whether it arrives as a single index or a multi-index. The closing prices are then converted into a percentage change format to represent stock returns, which are fundamental for our analysis. After calculating these returns, the mean and standard deviation are derived, which serve as the core parameters for our simulation: the expected return and its variability. Next, we set two key variables: the number of days for our simulation and the number of simulations we wish to conduct. With a reliable random number generator in place, we proceed to generate simulated returns based on our calculated mean and standard deviation. These simulated returns are crucial as they allow us to project the possible future price changes based on past behavior. We begin our simulation with the most recent closing price, and through cumulative product calculations, we generate a series of potential final prices. Here we identify two important metrics: the probability that the price will increase after 60 days and the likelihood of seeing a drop of 10% or more. These probabilities provide valuable insights, allowing investors to gauge potential risks and opportunities. As we display the results, we articulate the starting price, the probability of price appreciation, the risk of significant decline, and specific price quantiles. Each of these outputs offers a unique perspective on potential future price movements, enriching our understanding and preparing us for informed investment choices. In the next cell, we will likely explore how to visually represent these simulated outcomes, enhancing our comprehension and effectiveness in analyzing stock price behaviors over time. Cell 12. In this code cell, we're diving into a probabilistic model that uses bootstrapping for simulating asset prices over a specified number of days, which is crucial for understanding potential future outcomes based on historical return data. This approach allows us to model uncertainty more effectively, especially when considering fat tails or extreme outcomes that traditional models might overlook. The first step here establishes the parameters for our simulation, specifying that we want to simulate price movements over 60 days with a total of 5,000 independent simulations. By utilizing a random number generator, we ensure that our simulated returns are stochastic and reflective of the underlying data. The core of this process involves sampling from historical returns, a choice that enables us to create resampled paths of returns that build upon real-world data. Next, we generate a simulated price trajectory by taking the last known price and adjusting it according to our bootstrapped returns. This is done using a cumulative product operation, which allows us to compound the returns sequentially over the simulation period. As the code progresses, we focus on capturing the final outcomes of these simulated price paths. By extracting the last row of our simulated price matrix, we gather the potential ending prices from all simulations. The outputs we're interested in are the expected final price, which represents the average outcome across all simulations, as well as specific percentile values to gauge worst-case and best-case scenarios. This gives us a clearer picture of potential price fluctuations and helps to quantify risk. It's important to keep in mind that while this model is powerful, it assumes that the past returns captured in our dataset are indicative of future performance. As with all simulations, there are inherent assumptions about market behavior that we should be cautious of, particularly concerning extreme events that may not follow the patterns we've observed. Looking ahead, the next cell will likely explore further implications of these simulated outcomes, perhaps investigating the advantages and limitations of the bootstrapping method, or contrasting these simulated results with actual market scenarios. This will help solidify our understanding of financial modeling and risk assessment in a practical context. Cell 13. In this cell, we're diving into a probabilistic model that distinguishes between two key market conditions: calm and volatile regimes. Understanding these regimes is crucial for making informed trading decisions and risk management, as they can significantly impact asset returns. First, we calculate the rolling standard deviation of returns over a 20-period window, which helps us gauge the volatility of the asset. This rolling standard deviation is stored in a variable called vol20, and we drop any missing values to ensure our analysis remains robust. The next significant step involves defining a threshold for volatility, set at the 75th percentile of our rolling standard deviation. This threshold allows us to categorize periods into two distinct regimes based on whether the current volatility exceeds this benchmark. Here we're assigning a value of 0 for calm periods and 1 for volatile ones, effectively creating a binary variable called regime. We also align our returns data, ensuring that it corresponds precisely with the indices of our calculated volatility. This alignment is crucial for maintaining the integrity of our analysis. Following this, we compute the mean and standard deviation of returns for each regime. For the calm regime, we extract the average return and volatility using mu0 and sig0, while mu1 and sig1 serve the same purpose for the volatile regime. Finally, the outputs reveal the characteristics of each regime. By printing these results, we gain insight into how returns behave differently depending on the prevailing market conditions. A key assumption here is that our choice of a volatility threshold effectively captures the transitional nature of market regimes. But learners should remain cautious of potential pitfalls, such as overfitting or misinterpretation of results. As we move forward, the next cell will likely build on these insights by exploring how these regime classifications can inform strategic decisions or model predictions. Cell 14. In this code cell, we're reaching the conclusion of our analysis, signaling the end of the process we've been focusing on. It's important to recognize that wrapping up our code often helps to summarize the results and prepare for the next steps, such as evaluation or visualization. The last lines of code are essential, as they finalize the outcomes we've derived from our previous computations. We might be storing results, closing files, or even setting up important variables that will be used later on. By effectively managing these final touches, we ensure that everything is neatly packaged for interpretation. Throughout our exploration, we've put a lot of emphasis on key parameters and how they interact with one another. Here, as we close, it's crucial to reflect on what our variables signify and how they were derived. Consider any assumptions made during our earlier steps. They inevitably affect our conclusions and should always be noted when wrapping up. Additionally, while everything might seem straightforward, you might want to keep an eye out for any potential pitfalls. For instance, are all the variables set correctly, and are we confident in the data integrity before we finish up? These details matter, as they can influence everything that follows. As we prepare to move on, think about how this concluding segment will set the stage for our next venture. Our upcoming cell is likely to focus on synthesizing the information we've gathered and reflecting on what it all means in a broader context. This is where we'll dive deeper into interpretation and draw actionable insights from the work we've accomplished thus far.